Good evening. This is Ken Long from Tortoise Capital with a review of the weekend trading plan for July 14th, 2013. All the folks out here in Raleigh are saying, hey. We have a market that is in bullish normal conditions on an annual basis using weekly RSI 14. It's at the high end of neutral at 69 out of 100. On the 10-day basis, using the 10-day NDX, we are well into the overbought territory at 95 out of 100. Looking at the indicators of the market mosaic, percent stretch relative to the 200-day moving average is green bullish at 11.15%, so 9% above sideways and all signs pointing up. Slope of the 50-day moving average has improved to 0.51%, but which is still coded yellow neutral. ADX is at 17.7, so a non-trending market, but with bulls now in charge, and that what that means is that there's a potential 5 to 8% move available on the next leg up without too much difficulty on a technical basis. ATR percentage has declined into the middle range of normal, down to 1.10%. That's a drop of about 40% from the recent volatile high of about 2 weeks ago. The risk index, which is the moving average 30 period of the VIX compared to the 10-period moving average of the VIX, is at 1.11, so that favors the risk on trade. On a z-score basis, looking at the last 5,000 trading days, that comes in at a z-score of 1.24. You can see the time series of that over the last 90 days. After bottoming it out at minus 1.5 z-score, it has moved north above 1.0, so this is becoming very risk-on, or encouraging the long side trade. That's been a very good volatility trade over the last 10 days. Blended monthly rebalancing currently is holding financials, healthcare, and consumer discretionary, and the 13 ETF portfolio is holding Japan, U.S. small caps, and the Dow 30 industrials, with the next reevaluation being due on or about 1 August. In ETF 2, the theoretical exposure of the market is at 70%. The model portfolio will be at 80% exposed, and we'll be buying 2 positions, IBB, which is the biotech index, and IWO, which is the small cap growth index. Trades of the week can be found at the youtube.com channel under Kennifer 8. Quick look at the current readings on the blended monthly rebalancing. You can see in the 13 ETFs, about half of them are on a buy signal, with small caps clearly in charge, and most of the internationals still on cash positions, which are below their 4-month moving averages. On the 32 ETF portfolio, again, about half are on a buy signal, which is an improvement over last week when only about a third of them are. So the market is starting to turn, and some of the internationals are starting to cross over into the buy position, and the leading candidates in the internationals are the large cap mature companies of the European 350 Index, IEV, and EFA, which is the Euro-Asia blend of mature companies. The emerging markets in the smaller countries are slower to respond, so this is a market recovery that's being fueled by large cap, conservative, well-established companies and the larger country markets. So I expect that trend to continue in terms of leadership going forward. Looking at the market health check, the dark blue region in the middle is the 30-period Bollinger Band plus or minus 1, which is the river. The lighter shaded blue area is the 30-period Bollinger Band plus or minus 2, and that is the floodplain. The thin red line in the middle is the 30-period simple moving average, or the midpoint of the river. The orange-looking ribbon is the 2-period Bollinger Band, which represents real price, and you can see that real price has left the floodplain. This is the beginning of irrational exuberance, potentially. What I like about it, however, is it's just now cleared the previous swing high ribbon at 167, which argues of the potential of a 5 to 8% move above on the next leg up, which is not impossible. You can see that the river itself has just started to flow upwards. The 30-period regression line is just getting ready to leave the river, which would be the beginning of trending behavior to the upside. Thick black line in the middle is the 30-period regression line, lagged by 1 day. The RAF regression channel is formed on the outer black lines, which is the channel formed by the maximum excursion from the regression line during the look-back period, which sets a target of about 170 as the upside of normal in that technique. The solid red lines, the horizontal red lines, are previous levels of support that have held, and those would be downside targets. If the market fails here, we would expect the first target to be back at the Bollinger Band mean around, looks like about 153, 154. And you can see that the slope of the regression line, this black line, has rolled over and is now just crossed positive, which could be the beginning of the next leg up, which is why we're cautiously optimistic here. Williams percent R, the market's been oversold now for about 6 or 7 days. It can stay oversold for long periods of time, as you notice from back in May when it was oversold for almost 20 days. The vertical blue lines representing 10-period chunks of trading as we look to the past. The percent price oscillator on the bottom now, the jaws of the dragon are opening upwards, which indicates potential for more upside, and that helps support the case for a 5 to 8% move going north. This is the same idea, but now expressed at freestockcharts.com. Last week, when we looked at the market, it had just reversed from outside of the floodplain. You can see that the ribbon and this spiky tail down had been outside of the floodplain and reversed to close higher, and we were looking at entries upon entering the river, entering the floodplain, excuse me. That's the Anderson regression line stretch. And then a second position when price entered the river with a target at the Bollinger Band mean, and that's where it was last week, and we looked at the possibility of it getting to the edge of the river and the edge of the floodplain to retest the swing high. And this week, that's in fact what it did. It didn't even hesitate at the Bollinger Band mean and now has closed right at the edge of the floodplain. So we're aware of the potential for a continuation leg upwards of another 6 to 8%. This is the regional report from the ETF2 database. 3 of the 10 regional ETFs are on a cash position. That's priced with respect to the 4-month moving average. And 7 of them are on buy positions, and that's why the theoretical model is at 70% invested, 30% cash. That's a 20% improvement from last week when it was 50-50. And because of that 20% improvement, we're going to buy 2 more positions and get us to 80% and focusing on the strength leaders, biotech and small cap growth. In the battle for global domination here, S&P remains stronger than the rest of the world. EFA, the S&P is at 59 strength, EFA is at 51, so the U.S. is still in charge here. But inside the U.S., there's been a shift in leadership away from large caps, which is the cautious risk-on trade, and now the small caps, mid caps, and tech have moved ahead of the large caps, and that, I think, represents a shift to risk on inside the U.S. and the potential for another range expansion to the upside with the risk on leaders. The 2 strongest sectors in the world right now are the U.S. small caps at 64 and Japan at 60. The 2 weakest sectors are Latin America ILF at 25 and EFA at, EPP, Asia less Japan, at 38. Looking at the sector spiders, the 3 strongest continue to be discretionary, healthcare, and industrials, although now even the financials are coming on strong, and everything in the sector spiders is well above average, so that's broad strength inside the U.S., and that's why I think it continues to be the leadership going forward. Looking at the world market model through that lens, inside the U.S., any small cap is solidly in the green, so well above average. The rest of the U.S. is in the white, so above average. China is well above average. Oil is well above average. Other leaders inside Asia is Japan in the white, Malaysia and Taiwan, with the rest of Japan below average, with Australia lagging way behind as a reflection of the weakness in commodities lately. Looking at the commodity sector, gold, silver, And then the alternate asset class of treasuries are extremely below average. Private equity remains strong. Real estate is slightly below average. Um, Latin America and the emerging markets are weak. Everything Europe is strong, with the exception of Australia and Austria and Spain. Taking a look at the global versus the U.S. business sectors, in every case, the U.S. sector is better than or equal to its global counterpart, and that's a reflection of broad-based strength inside the U.S. The exceptional winners right now, financials and discretionary. Consumer discretionary is a global strength phenomenon here. As you can see, even the global discretionary is well into the green. The top 30 ETFs based on this ETF2 lens, it's the same leaders as last week. Solar energy, alternate energy, biotechs, financials, consumer discretionary, healthcare. So the leaders continue to lead. The ones that are green on the strength and white on consistency are ones that are adding strength, because now the shorter term measure of strength is better than the 10-week moving average of it. So those that are green in strength and white in consistency, we'd be looking at crude oil, United States oil, small cap growth in the small cap broad index. That's the beginning of strength in the small caps, which is why I like it for ETF2 and to be a continued leader going forward. Looking at the Dow 30 through the same lens, the weakest symbols in the Dow 30 are still in the yellow, which means that they're broad-based strength in the large caps inside the U.S. Hewlett-Packard remains at the top of the list. Leader continues to lead at 26. Microsoft, Cisco, American Express, and Boeing continue to lead the way. 3M is beginning to show some strength because it's green on strength and white on consistency. The weak companies, IBM and Alcoa. Caterpillar has started to move. It was in the second weakest position, is now number 5 in the stack and starting to move up. I see that as a potential beginning of strength coming into industrial and base materials. So we'd be looking for both Alcoa and Caterpillar to take advantage of an expansion of business activity. So we'll look at them moving back up into the white and perhaps outperforming the rest of the Dow. This is a quick look at the ETF liquidity based on daily dollar volume. Those that are in the green are exceptionally liquid and exceptionally volatile and make great intraday trading targets. That's the gold miners and the short-term VIX. And that's a quick look at the weekly market report. I just want to hit a few highlights out of the daily trading plan. We've got short signals in Asia, less Japan, and emerging markets. I would not take those based on the strength that's flowing into the market. I would wait and see. No pattern trades to speak of because of the very strong close. The max pain range compression candidates in the Dow, none of them test out better than 2 to 1. So I would look just to go after the leadership candidates there and play the broad indexes like the small caps and possibly Hewlett-Packard. Inside the ETF 30 tactical summary, a handful of dojis to consider, but really it's the VIX and Latin America show better than 2 to 1 on the auto framer, so I'd look at them as number 1 and number 2 as max pain range compression candidates. No symbols on either set test out well on the RSI2 value. In the auto framer, it's the VIX, Brazil, and Latin America, and here's the framing data for your daily trading plan. 30-day regression line time series, you can see how that slope is improving and there's acceleration away from the average. This is start of the beginning of a runaway. We were alerted to this possibility about 5 or 6 days ago when the slope of the 30-day regression line crossed its 10-period moving average at an extreme distance from the 6-month average, and that gave us the alert that potentially this was a swing low. You can see on a percent stretch relative to the 200 how it bottomed out at -2 standard deviations and is now back to the 6-month normal. And now there's room for another 6 to 8% move to be within the range of normal. And that's why I like this potentially this next leg up. And that's everything I want to cover from the daily report. Got to get this off to the printers as we're getting ready to fly home. Keep your risk measured and your powder dry. We'll see you in the chat room. Be ready for long side range extension to the upside, focusing really on XIV, the lack of volatility, plus the U.S. small caps to lead the way. It's Ken Long from Tortoise Capital, and we'll see you in the chat room. About 15 minutes.